Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we are going to be talking about an extremely important part of the Forex puzzle known as the Commitment of Traders Report, or the COT Report for short. The COT Report is a weekly updated sentiment report that can provide us with important information on the positioning of currency pairs. The COT Report is issued by the Commodities Futures Trading Commission, known to most as the CFTC. It can be used in conjunction with the trader's underlying strategy in order to enhance results. The COT report offers us statistics on the positions of futures traders across a wide range of markets and is quite often used as a proxy for the Forex trading market. Within the weekly report, the CFTC gives us the amount of long and short positions and overall open interest according to 3 separate trading groups. Surmising this data, especially over long periods of time and assessing for changes in average position, can prove valuable for us in terms of building ideas of strength and weakness to come within certain currencies. The largest futures traders in the world are required to report their positions to the CFTC. The positions can be easily tracked due to the margin they must pay to hold their large positions, which the CFTC has been publishing since 1962. Even though this information is slightly lagging, do not underestimate its extraordinary value. The reports are released every Friday at 3:30 p.m. Eastern Time. This information is very valuable to traders due to the nature of the groups that come into the futures market. This includes institutions like hedge funds who enter to make a return above their respective index. Some of the largest companies in the world with real-time data reflecting the health of an economy come to the futures market to hedge their exposure to price fluctuations of raw materials that they use to make their product. This allows traders to gauge the positioning of sentiment in the market at that specific time. We mentioned earlier about the 3 groups included in the COT report, so let's talk about these groups a little bit. Firstly, we have commercial traders. These are mostly large multinational corporations with commercial hedging interest in their respective future markets. For example, a large Japanese manufacturer may want to hedge their exposure fluctuations in the USD-JPY exchange rate. Secondly, we have non-commercial traders. The figure shown here often relates to large speculators such as commodity trading advisors and similarly large institutions speculating in specific futures markets. Lastly, we have non-reportable traders. Non-reportable traders are the traders who do not fall into either pre-mentioned group. Most often they are likely to be small speculators. They are less significant in COT report analysis as they don't control a large enough piece of the market collectively. Application. Let's now look into how we can use the COT report to trade. The market can have short-term bullish behaviors and long-term bearish downtrends as reflected by abnormally large retracements on our chart. The report is designed to gauge supply and demand of key market participants. We can use it to confirm mid-long-term fundamental bias in any given market. A decrease or flat non-commercial long positions on rising prices might suggest the end of a bullish trend. Traders should seek to enter a short setup near prominent resistance. An increase on short non-commercial positions on falling prices might support the downtrend. Some traders may look into hedgers' behavior and analyze their positioning in the market. Some traders believe that these traders are the biggest in the market, therefore they know the market best. Other traders would analyze speculative positioning. Additionally, traders like to look at both groups' open interest. In most cases, they would generally be opposite. There are many ways of looking at the data, but let's discuss extreme level swings and net positioning. In extreme level swings, there is a strong correlation between multi-year high or low positions and the market swings. On this chart, we analyze Euro-USD and the Euro-FX commitment of traders data. Commercial traders were at a multi-year low or high levels right before the price lost momentum and reversed. We generally want to wait for the highest or lowest level in 3 years to consider entry for a long-term reversal. The commitment of traders is not a market entry tool but a sentiment analyzer. It will indicate the current trend is about to end, but usually it is likely to continue on before its reversal. We never know how far, as the market's participants are always growing over time and it may be difficult to predict the exact top or bottom. Our entry can always be chosen using technical price actional signals. These could be anything and individual to your trading strategy. Examples include candlestick analysis on daily or weekly charts such as double tops, divergences, or anything else provided it has proven reliability and suits your trading style and strategy. Next we have net positioning. Net positioning is a arguably more accurate and reliable method compared to the extreme level strategy. In this method, we prioritize thinking about trend change if the speculative positions turn net long or net short. Speculators will be net long if their long positions exceed their short positions. In other words, they will have a higher long balance than short. On this example, speculators are holding more short positions than longs, meaning that they are net short. On this chart, we see how speculators turned bullish or bearish on multiple occasions. Every time this occurred, the price reversed and followed the supply or demand law. When the speculators turned net long or net short, the price climbed or fell substantially in its relevant direction. Again, please remember this is not a tool for entry. Market entry should be determined using our other technical indicators to increase our chances of success. In summary, the COT report is not a market entry tool. The market trends can be short-term bullish in long-term downtrends, and this promotes keen observation around the speculator statistics. We can use the COT report in order to gauge supply and demand of the most important market participants, and we can use it to confirm mid-long-term fundamental bias in any given market. Hopefully you have enjoyed this discussion today, ladies and gentlemen, and now have a greater understanding of the COT report analysis. Please sit back and contemplate what you have learned today, and remember, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.